Gold just hit $5,100. Bitcoin is sitting at $64,000, down 47% from its all-time high. And for the first time in a decade, serious institutional money, not retail commentators, not crypto skeptics, but JP Morgan analysts, Bloomberg intelligence teams, and sovereign wealth fund managers, is asking a question out loud that was considered heresy 18 months ago. Is Bitcoin actually digital gold? Or was that always a story we told ourselves? And here is what makes this moment genuinely important. The answer to that question determines everything about how you should be positioned right now. Because if Bitcoin is digital gold, this drawdown is a buying opportunity. But if Bitcoin has become something else entirely, something the market is only now beginning to correctly classify, then the entire valuation framework needs to be rebuilt from scratch. So let's do this properly. Let's look at the actual data, the actual correlation structure, the actual capital flows, and the actual institutional behavior. And by the end of this, you are going to have a framework that cuts through every headline and every opinion and gives you something you can actually use. Let's start with the raw numbers, because the divergence is impossible to ignore, and it demands a real explanation. Gold surged more than 60% in 2025 on sustained central bank buying and flight to safety demand, while Bitcoin has struggled into 2026, posting repeated monthly declines and underperforming major risk assets. Gold above $5,100. Bitcoin down from $126,000 to $64,000. Bitcoin has been falling against gold for approximately 14 months, achieving its highest relative level in December 2024 before this current underperformance cycle began. 14 months of Bitcoin losing ground to gold. That is not a blip, that is a structural divergence. And the question is whether it is temporary, a phase within a longer cycle, or whether it represents something more fundamental about how the market actually perceives these two assets. Now, before we go deeper, I want to frame this properly. Because the digital gold narrative was never just marketing. It was a thesis built on a specific set of claims: fixed supply, censorship resistance, store of value in an era of currency debasement, non-correlated returns during macro stress, independence from the traditional financial system. Those claims were the intellectual foundation of the entire Bitcoin investment case for a certain class of institutional allocator. And what is happening right now is a live empirical test of every single one of those claims simultaneously. And some of them are passing the test, and some of them are failing it, and knowing which is the entire game. Let's start with the correlation structure because this is where the data is most brutal and most honest. The 30-day rolling correlation between Bitcoin and the Nasdaq 100 hit 0.80 in January 2026, the highest level in nearly 4 years. 0.8. That is not a small number. A correlation of 0.8 means that on 80% of trading days, Bitcoin and the Nasdaq are moving in the same direction by roughly proportional amounts. That is not a hedge. That is a high beta tech exposure. During recent geopolitical tensions surrounding Trump's tariff threats, Bitcoin lost 6.6% of its value while gold rose 8.6%. Think about what that means structurally. The single scenario that Bitcoin was specifically designed to thrive in, geopolitical uncertainty, currency instability, institutional distrust, is producing the opposite of the predicted result. Gold is going up, Bitcoin is going down. That is the core empirical problem the digital gold thesis is facing right now. And the institutional money is reading that data and responding accordingly. U.S. spot Bitcoin ETFs experienced a 4-day outflow streak totaling $1.62 billion in early 2026, with major funds including BlackRock's iShares Bitcoin Trust and Fidelity's Wise Origin Bitcoin Fund leading the redemptions. These are not retail panic sellers. These are registered investment advisors and institutional portfolio managers making deliberate allocation decisions based on correlation data and risk-adjusted return calculations. When the correlation to Nasdaq hits 0.8, Bitcoin stops doing its job in a diversified portfolio. And when it stops doing its job, rational allocators reduce the position. That is not fear. That is portfolio construction. Now here is where the analysis gets genuinely interesting, because the question of why this correlation has risen is not a simple one. And the answer reveals something important about what Bitcoin actually is, and what it is in the process of becoming. Evidence from 2025 and early 2026 indicates that Bitcoin behaves more like a technology risk factor than a monetary hedge. But why? What is the mechanism that has produced this behavior? The answer runs through 3 interconnected channels, and understanding all 3 is essential. The first channel is the ETF integration effect. Before spot Bitcoin ETFs existed in the United States, Bitcoin was owned primarily through direct wallet custody, offshore exchange accounts, or futures-based products. The holder base was dominated by people who had made deliberate, friction-heavy decisions to own Bitcoin directly. Those holders had strong conviction, long-time horizons, and low sensitivity to short-term price moves. The introduction of spot ETFs fundamentally changed the ownership structure. Now, Bitcoin can be bought and sold inside the same brokerage account where someone holds their S&P 500 ETF, their Nasdaq ETF, and their bond fund. That integration into the traditional financial plumbing means that when a portfolio manager decides to de-risk across the board, when a macro shock triggers a broad risk-off move, Bitcoin gets sold in the same button click as the tech stocks. ETF flows can amplify moves in both directions, an easy on-ramp and an easy exit. The liquidity sponge identity matters more now because institutional access is bidirectional. The very mechanism that brought institutional money into Bitcoin, the ETF wrapper, has also made Bitcoin more behaviorally correlated with the assets that institutional money already owns. The second channel is the leverage structure. Bitcoin whales executed a coordinated sell-off of $2.78 billion in January 2026, pushing prices below $86,000 and overwhelming retail demand. This distribution phase, spanning 48 to 72 hours, involved both direct exchange sales and over-the-counter transactions, testing market liquidity and amplifying downside volatility. And on top of that concentrated holder selling, the derivatives market amplified every move. Leveraged long positions forced into liquidation created cascading mechanical selling that had nothing to do with fundamental reassessment and everything to do with margin mechanics. Such coordinated activity by concentrated holders would be impossible in gold markets, where holdings are far more distributed. The concentration creates systemic fragility. Gold's ownership is distributed across central banks, sovereign wealth funds, jewelry markets, industrial users, and hundreds of millions of individual holders globally. No single actor or coordinated group of actors can move gold the way concentrated Bitcoin holders can move Bitcoin. That structural difference in ownership distribution is a genuine and meaningful distinction between the two assets. The third channel is central bank demand, and this is the one that matters most for understanding the divergence. Gold is experiencing strong structural demand from central banks and institutions. Gold rising while Bitcoin falls is not a retail speculation trade, it is a sovereign reserve diversification trade. Central banks around the world, particularly in emerging markets seeking to reduce dollar dependency, have been buying gold at record levels. That is not sentiment. That is not retail enthusiasm. That is a structural institutional bid that creates a persistent price floor. Bitcoin has no equivalent. No central bank has Bitcoin on its balance sheet in any meaningful quantity. No sovereign reserve framework has been established. No multilateral institution holds Bitcoin as a reserve asset. The demand structures underneath the two assets are fundamentally asymmetric right now. And that asymmetry explains a significant portion of the price divergence we are watching in real time. Now, here is where most analysis stops, and here is where I want to go further. Because the question is not just, why is this happening? The question is this permanent or is it a phase? And that distinction is everything. Bloomberg analysis argues Bitcoin is facing a $1 trillion identity crisis, as falling prices, ETF outflows, and rising competition from gold, stablecoins, and prediction markets are testing the asset's long-standing narratives. The Bloomberg framing is real, and the pressure is real, but identity crises are not always permanent. Sometimes they resolve, sometimes they produce a cleaner, more accurate, more durable identity on the other side. And I want to make the case carefully, probabilistically, not with false certainty, that Bitcoin's current identity confusion may be a transitional state rather than a terminal one. Here is why. In a shock regime, trade disruptions, geopolitical escalation, or a credit event, Bitcoin's initial correlation spike is followed by a potential hedge narrative re-emerging. Post-shock, if the dollar weakens and monetary or fiscal support rises, Bitcoin can regain hedge-like behavior. The transmission is not immediate, it is lagged. Bitcoin does not respond to inflationary fiscal policy in real time the way gold does. It responds with a delay, as the monetary consequences of that policy work through the system and as the narrative framework updates to reflect the new monetary reality. We saw this in 2020 and 2021. The Federal Reserve's balance sheet expanded massively in March 2020. Bitcoin's response was not immediate. It took months for the full repricing to occur as the monetary expansion consequences became undeniable. The same dynamic may be in play now. The fiscal consequences of sustained tariffs, potential deficit expansion, and dollar debasement pressure are real. Their full transmission to Bitcoin's valuation may simply be lagged. JP Morgan argues that Bitcoin's relatively low volatility versus gold underscores its long-term potential as a safe haven asset. JP Morgan's volatility-adjusted comparison to gold implies an upside target near $266,000, which analysts agree is unrealistic this year but shows the upside potential over the long term once negative sentiment is reversed and once Bitcoin is again perceived as equally attractive to gold as a potential hedge. $266,000. That is not a number JP Morgan is promising. It is a number derived from a mathematical model of what Bitcoin would be worth if it were perceived and allocated to the same degree as gold on a volatility-adjusted basis. The gap between current price and that model output is the gap between current institutional perception and the potential future institutional perception. Closing that gap, or even partially closing it, is the medium to long-term bull case. Now let me give you the cross-cycle framework, because the Bitcoin versus gold ratio has its own historical pattern and most people are not watching it. Preceding BTC versus gold bear markets happened in 2013 to 2015, 2017 to 2019, and 2021 to 2022. The current underperformance is of similar duration to prior cycles, and each time the digital asset subsequently rose to multi-year uptrends against gold. 3 prior cycles. 3 periods where Bitcoin dramatically underperformed gold. 3 subsequent periods where Bitcoin dramatically outperformed gold. Traditionally, when gold performs better than Bitcoin and the Bitcoin versus gold RSI hits its deepest possible lows, a drastic upswing in Bitcoin price follows. We are at those RSI lows right now. That does not guarantee a reversal. Markets can always extend further than historical patterns suggest. But it does mean that the probability-weighted framework for the Bitcoin-gold ratio points toward mean reversion rather than permanent divergence. The question is not if, the question is when and from what level. And here is the macro allocation modeling perspective that ties this all together. The institutional narrative around Bitcoin is not static. It has evolved dramatically, and it will continue to evolve. 2 years ago, the question was whether Bitcoin deserved a place in institutional portfolios at all. That question has been answered. The ETF approval, the AUM growth, the adoption by major asset managers resolved that debate in Bitcoin's favor. The current question is what role Bitcoin plays in those portfolios. Is it a risk asset, a hedge, or something novel that doesn't fit existing categories? That question is being answered in real time through market behavior, and the current answer, high beta tech risk factor, is almost certainly not the final answer. Because the fundamental properties of Bitcoin, fixed supply, censorship resistance, no counterparty, no jurisdiction, did not change when the correlation to Nasdaq rose to 0.8. What changed was the market structure around Bitcoin, and market structure changes are more temporary than fundamental properties. BlackRock's Bitcoin ETF options soared to become the 9th largest in the American market, surpassing gold ETFs, with trading volume rising higher than that of VanEck Gold Miners ETFs and SPDR gold shares. Read that again. IBIT options volume is now larger than gold ETF options volume. The infrastructure of Bitcoin as an institutional asset is not declining. It is expanding. The sentiment is negative. The correlation is unfavorable. The short-term price action is painful. But the underlying institutional infrastructure, the options market, the futures market, the ETF ecosystem, the regulatory framework, is deepening and maturing through this drawdown, not retreating from it. That divergence between infrastructure development and price sentiment is historically one of the most reliable signals that the current narrative is temporary. So where does this leave us with the central question? Is Bitcoin digital gold? The honest answer right now is not in practice, but potentially in structure. In practice, Bitcoin is trading as a high beta risk asset with an 80% correlation to the Nasdaq. In practice, it is selling off when gold is rising during macro stress. In practice, the market is not treating it as a safe haven. Those are empirical facts, and dismissing them is intellectually dishonest. But in structure, in the fundamental properties of the asset itself, nothing has changed. The supply cap is intact. The issuance schedule is intact. The decentralization is intact. The censorship resistance is intact. The fundamental case for Bitcoin as a long-duration monetary asset has not been weakened by the price action. It has been tested by it, and the test is ongoing. What needs to happen for Bitcoin to reclaim the digital gold narrative in practice? 3 things. First, the Nasdaq correlation needs to compress, and that happens naturally as the ETF holder base matures and short-term sentiment-driven allocators are replaced by long-duration conviction holders. Second, central bank or sovereign wealth fund allocation needs to materialize at scale. A single meaningful sovereign reserve adoption announcement would shift the institutional narrative overnight. Third, a sufficiently large fiscal or monetary shock needs to occur where Bitcoin's response leads rather than lags gold. A single clear episode of Bitcoin performing as a safe haven during market stress would recalibrate the institutional perception framework significantly. None of those 3 things requires a change to Bitcoin's fundamental properties. They require a change in the market's understanding and treatment of those properties. That change takes time. It takes catalysts. It takes the kind of patience that most participants in this market are not structurally equipped to maintain. But that gap between current treatment and potential treatment is where the long-term investment case lives. Bitcoin's identity crisis in 2026 is not a philosophical debate. It is an empirical rotation between three measurable regimes. The current regime favors high beta tech identity. That can change, and the signals are observable. Correlation shifts, real rate moves, ETF flows, and monetary plumbing indicators. The next regime will reveal which identity dominates, and the answer will appear in the data before it appears in the narrative. Watch the data, not the narrative, not the headlines, not the Twitter sentiment, the correlation data, the ETF flow data, the realized loss data, the long-term holder behavior data, the sovereign allocation announcements. Those are the leading indicators that tell you when the regime is shifting, before the price moves, before the narrative updates, before the consensus catches up. The people who get this right are not the people who picked the right label for Bitcoin. They are the people who understood that the label is dynamic, that the market's treatment of any asset is a function of its current ownership structure and current macro regime, and that identifying the transition between regimes before the consensus is where asymmetric returns are generated. Right now, Bitcoin is a risk asset trading like a high beta tech stock. Structurally, it is a fixed supply, censorship-resistant, non-sovereign monetary asset with properties no other asset in history has possessed. The gap between those two descriptions is the trade. And understanding both simultaneously, without collapsing into either blind conviction or blind cynicism, is the intellectual foundation of navigating this market with any real precision. That is the analysis. That is the framework. I'll see you in the next one.